All right, folks, let's get rolling. Thank you and welcome to the webinar. Happy Friday. It is almost mice down, drinks up time. Boy, what a crazy market environment we have. I am honored to be here with special guest Craig Scott, someone who I've been following for a number of years in the market, been an incredible mentor to me. Craig, thank you for taking the time and joining me today. How are you doing?
Good, man. How's it going, Ryan?
It's going real good. So I would
Good.
say let's just jump right into this. First of all, Craig, for the people that don't know you on this webinar, can you give me a little bit about your background, how you got into the market, how you got started? Your getting started story is priceless.
I've always pretty much been in finance and accounting. Was my major in college. Took an interest of it. It started in high school. And the story goes, so I was in the AP economics class. They had just started it. I believe it was its first or second year at Monroe. And we entered a statewide stock market contest where, they mail in you mail in a form, you pick your stocks every month, you revisit it, they give you the results, and then they rank you. And back then, she would have the kids bring in papers and you look in the stock listings and you discuss it and pick out which ones you want. So as it turns out, my OCD and A personality, I took charge of that. And we were midway through the year and we were middle of the pack. Things were just slow. The whole process was slow. There was no internet. So I took it upon myself to pose as the principal. I wrote a letter to the people that were running it that the teacher had taken ill and she wasn't going to be able to respond, to send all correspondence to me. And I would be writing it because I wanted to get the changes in faster, the buys in faster, the sells in faster. And she would just be like, leave it on her desk for a week. Then the stocks would go down and I'd be upset. And so, that charade I got to last for about 2 months before they called me out on it. Went to the principal's office. Mr. Stein wasn't happy. And, it turns out we ended up doing really well with the contest, but, it got me in some hot water. But yeah, even back then it was active. Had to buy, sell, and it wasn't like it is today, but there was no, high frequency and things. But we, by the time you got snail mail, be 2 weeks and things would have changed. So that's how it all started. And then it had just evolved from there. I went to college for finance and accounting, graduated. I started at what's now PricewaterhouseCoopers in the audit, moved to the management consulting division, did some work in some investment banks downtown, and then started a staffing firm and a PE firm in the early 2000s, and away we go.
All right, awesome. So how long would you say that you've actually been actively trading the market? Not back to the contest, although that's pretty amazing. How long have you
my own personal money?
Yeah.
It goes back pretty far because I remember in college, I would be buying and selling some stocks on emergency loans that I would take from Rutgers because I had no money. So I would borrow $1,000 as an emergency loan and invest it in the market and try to make some money and then pay the loan back. So probably since 18, 19 years old.
Amazing. And in all that time, do you have a best and a worst trade?
Of all time?
Of all time. And it can be a current one if that's the case. It's up to you.
Well, my best current one that I'm sure some people are familiar with. I mean, when I was on Twitter years ago, I posted a lot more stuff, but I bought 100,000 shares of NVIDIA in the 40s. I don't remember exactly what it was. It was in the 40s. And I posted when I did it and took a lot of flack for it. And everybody would call me an idiot. And then I ended up selling it. Average sale was probably somewhere in the 200 range, back then. And some of my worst trades, God, there's so many. We could go back to late 90s when options were just becoming a real prevalent thing. And I wanted to trade a company called Exodus Communications, and you couldn't really get options on your platform. So I had to call up the desk and they didn't have it readily available. So I had to wait for a specialist to call the options room. They had to open up the option, and I put in a big order. And literally by the time he got back to me and told me I was executed, I was down 30% in the position. And by the end of that position, I was down 100%. And it was a pretty big number back then. But most recently, I mean, my biggest losses are by far in go-go. It's been the bane of my existence since I got into the name. And I gotta say, I don't know, probably 3-4 years ago, maybe 5, I bought it. My average cost was in the 9s. So it's been painful. And probably the more painful aspect of it was the opportunity cost that it cost me by having all that capital in go-go where it should have been deployed elsewhere. So big mistake on my part, big mistake.
Well, so the one thing that I want to say is one of the reasons that I was drawn to you early on is you've never been shy about sharing your losses. And for me, I've discovered that if someone is always talking about how much they win, they're not telling you the truth. And you've never taken that approach. And that's one of the reasons why I started this whole thing in the beginning. So I guess the next natural question would be, when you have something that you believe in or that you're invested in, and you take down a nasty drawdown on that, how do you end up dealing with that? I'm an emotional person. Emotions definitely take their toll on not only my personal life, but when I'm working as well, when I'm involved in the market. How do you handle things like that? How do you keep your positive attitude and your big smile through something so devastating?
It's not always a positive attitude and a big smile. As people know from my Steeler game rants, I've smashed TVs. I've probably smashed a few guitars in my life. I'm driven off emotion too. And it's been to my great advantage in trading. And it's also been my biggest detriment. So after the smoke clears and go-go is a good example. I'm in this big position and I'm getting throttled in it right now. So after you get over the anger of how you let yourself get into this, you take, and this is what I do with all my investments. And when I'm debating whether I should cut ties or maintain or even add to a position is, has my base case changed? And do I fundamentally believe in the same story I did when I bought it? And that's what goes through on the intellect level. Now, the emotional level is kind of different. It's just like, I'm going to buy more and I'm going to buy more and I'm going to show them and I'm going to make it go up. But that doesn't obviously work. So I defer to my intellect to try to guide me through the emotion, when I get to that point. But it's hard. It's hard. If you are an emotional person and type A, and most traders are, it's one of the most difficult things to have is being able to control your buy button.
And let me ask another follow-up question for that. Does it get any easier the more that you have? Because it seems to me, I've only been actively involved in the market for 7 years. All right. But it seems to me that this is a battle that I face every single day that I wake up. Every single day that I'm looking at my trading platform, I'm battling emotions. Sometimes I develop strategies that allow me to handle them a little bit better, but that fight is still there every single day. Is that the case for someone that has much more experience like yourself?
I think that, yes, the tantrums become fewer. Right. The anger still resides, but how it manifests itself is a lot different now. So I'm not just, all right, I'm going to buy more or I'm going to panic sell. Now, although I'm angry, I try to think through a process a lot more than I did, say, even 15 years ago. Especially with the markets now, if you are an emotional trader with the volatility going on, it's probably not going to be good for your heart. Might not be good for your P&L, and it might not be good for your stamina to stay the line for the long distance.
All right. And then you mentioned the crazy markets, and we are going to get to that in a sec. You also mentioned your process. And one of my questions here, and forgive me, does a chart fit into your process at all? If not, why not? And if so, why?
So now I'm just going to speak in a Twitter sense. 99% of the people on Twitter are technical people. They're technicians, they're chartists. That's what they use. To me, charts, if you are making investment decisions based on charts, you shouldn't be making any investment decisions. They are never a lead indicator. The narrative you can spin around any chart is to whatever the person telling you they want it to be. They could draw lines, they got their big magic markers with colors and double bottoms and Fibonacci retracements. That's all well and good. When you're making investment decisions, it should have zero bearing on any of your capital. Now, if you want to tell me that you want to use it for a 5-minute, whatever these guys do, a 5-minute quick trade, a scalp, great. If that works for you, that's fine. But no serious investor should be using a chart at any point to ever invest any capital as far as going forward, a predictive measure, anything like that.
So, and what kind of indicators do you use? Maybe indicators is the wrong word. What kind of things do you use to help craft your investment decisions? Do you read news? Are you, is it what you see in real life? How do you come across things that you're looking to purchase for an investment?
So now, I wouldn't recommend my methods to anyone either, because they are unconventional, and they probably only work for me. Just like, hey, charts work for you, then you stick to it. If whatever gets you green on the screen, God bless you. But for me, it's more of feel, fundamentals, and what I like to call fire, which is, you could start to see smoke or some avenue which would lead you to something that might be worth investing in. Things of that nature. So, and out of those three, the hardest one to explain would be feel, because I think that just comes with experience of seeing how stocks gyrate and what makes them move and what stories or headlines bring them down. And like I said, I go in with an investment with a fundamental picture of what I think the business is like, what I think it will look like, and why I'm investing in it. And those are things I revisit all the time. The fundamental story is a really big one here. I mean, go ahead, find me the chartist that said Clorox is going to go up 40 points. Go ahead. There'll be one because they make up their stories, but there isn't one. So you kind of got to keep your eyes open. A lot of it's common sense. I mean, if you kind of understand the way the world works, but, I look for different things that might ping, drops that are just have no rhyme or reason. The stock's just dropping, but the fundamental story hasn't changed. And, I'll look at, sometimes I'll look at option flow. It's not really a big thing for me, but when I'm making a decision, it is a factor I'll look at just to see if there's been any accumulations, any large blocks. But, those are the three factors I use before I put money to work.
Gotcha. Definitely. And I'm actually really glad that you brought that up, because you're exactly right. When I first started learning this, I don't have a Wall Street background. I studied finance in college, absolutely, but I never worked on Wall Street. So when I first started teaching myself this, I used technical analysis to help kind of understand why stocks made moves that they did. And I realized early on that while it did benefit me in some regard, it also seemed that, as you said, you can craft the narrative in any direction. And actually, since following you, I actually have started to develop my own feel for things, because I've watched news flow, I watch option flow a lot, and I've kind of seen how these things actually affect stocks that I'm familiar with, which is, in my case, mostly technology. So I've actually been able to blend both of these things together to make it work for myself. So it's great to hear that. I totally understand exactly where you're coming from on that. Let's go to the market. You had mentioned, there's no stock there's no chart that's going to show you what Clorox did or what SPY did. What do you think of these crazy markets and or the coronavirus and how it affects the actual market? So I guess we could take that in two pieces, because there's kind of a lot there.
Which one do you want to start with?
Let's start with the coronavirus real quick. What do you think about the coronavirus, and what do you think it ultimately is going to mean for the market going forward?
Well, I think the economic impact from the coronavirus will be far greater than anything we've seen. I don't know if it'll be something that's more long lasting than anything we've seen. I do think that we are in a deep recession. I think you're going to get a very ugly GDP print. Obviously, stocks are forward indicators, so they've repriced themselves to indicate that. Now, the debate's going to be is that have they repriced themselves enough? We just had a massive 20% move off the lows. And, you know, we dropped, I think, from peak to trough on February 19th, somewhere in the 35 to 38% range, wherever that, you know, plots you want to use. So I think it's the economic impacts are deep. I think the stimulus bill helps. You know, I don't know if it's going to be enough help, though, to stimulate spending, depending on the shape that people come out of this in. I do think you're going to have some pent up demand. I just don't know with the job losses and, you know, the savings depletion, how much money people are going to, well, you know, once they let us out of jail, how much money are people going to have to go on a vacation? How much money are people going to have to just do leisurely things that they used to, expensive dinners, you know, things like that? It might just be, you know, a slow, steady trodden pace. And also, I don't know what kind of social behaviors are going to snap right back. Like, for instance, baseball. All right, let's say we get a baseball season in July. Is everybody going to be comfortable packing into a 60,000 person stadium and sitting next to each other, beer spilling all over, getting a hot dog from a vendor who might have coughed or something? Like, there's so many factors that are going to play into this recovery that it's very hard to predict what the economy is going to be like. That being said, we've had, and I'd say this is probably for the past decade, a major displacement between economics of Main Street and economics of Wall Street. The stock market up until recently has done very well, and Main Street's done okay. They haven't been great. The rich got a lot richer. The poor are much poorer. The middle class is eroded. So can stocks go higher? Yes, as we've seen, they announced a $3 million job loss yesterday. Stocks rocketed higher. Does it make sense? I don't know, but I think that the impacts are going to be felt long beyond we declare victory over the virus. Now, as far as the impact it's going to have on stocks, this is a point. I started buying some in here, down here. Actually, before this run, I bought. I had a big trade. I bought Win when it hit 42. I bought a big block of it. I sold out of it yesterday at somewhere in the 70s. So
now, when you say sorry for jumping in here. When you say you sold out of it, did you liquidate your position or were you just selling?
Well, no. So I had it. So yeah, let me be clarified for transparency. I had a big position in Win to begin with, probably an average cost of about 90. When it dropped to 42, I just felt like it was really heavy in pricing and bankruptcy. So I stepped in and I added 75% to my position. When that ran up, I sold that tranche yesterday. I still am holding the 100K at somewhere around 89, somewhere around there, 90. And I'll continue to hold that. The stock, I think that now it's going to stabilize a bit till we get some clarity on Macau. Everybody was telling me that, Macau is, 75% of their income, which is true. But now that Macau is probably close to coming back online, does it get back 75% retracement? So we'll see. But that's one. So I picked my spots. I added to some names on the big dip here. After, I don't add positions in big up markets. That's a rule of mine. I'll never add to a position in a big up market. It's just uncomfortable for me.
Buy low, sell high makes a lot of sense.
Well, I mean, gap downs are great for me because a lot of the times I'll buy right at the open during amateur hour when a lot of people shouldn't be in there, and I'll just buy it. And then, it'll run up, and either, depending if I'm buying an options trade for a trade, I'll sell it, or if it's something I want to hold on to for the long term, I'll hold it. But I'll never buy on a big jump. And so as far as where the market is now, I think we're in a wait and see approach. I think you've had the big drop down. I think you've had the rip up. I think you're going to get some bumps, little spikes up, little spikes down. But I think you'll see volatility come in until we get some more big news. Either in the next 2 weeks, we're going to get massive cases. We're going to get the healthcare industry on overload, basically imploding, or you're going to start to see the curve flatten, some easing of the tides, and healing begin, or at least project when the healing might begin. Right now, we really don't know. So right now, I'm kind of in a holding pattern. I think the market is probably there too for at least maybe a couple days. It's hard to say where we may go, but I think we're going to be in a range bound for a bit here.
Now, would you advise that people get into the market? I mean, we have a huge sell-off, right? So we have quality stocks that are available at what are considered discount prices. Would you advise that people start investing now, or would you advise that they kind of wait this out? Obviously, we don't want rookies trying to time the bottom, because we all know that that's a futile enterprise. But would you advise younger or newer people to actually start getting involved in the market at this time?
Well, first, let me say, I don't advise anybody. I'm not licensed to advise, so I don't. However, I like to speak on what I do. So if I was 18 again, or, and I had some savings, this for me would not be a bad opportunity to start buying some things that I understand. And I always like to tell people when they ask me, well, what do I buy? I want to invest in stocks. What do I buy? And I say, I can't tell you what to buy. Here's what I can tell you. Buy things you understand. This is what I tell my kids. Buy things you understand and see and feel every day. So for kids, it's a lot of Apple, Nike, Under Armour, Starbucks, Disney, things they can relate to. So when they see in a store, they can touch it. They can be like, Apple. I own a couple shares of Apple. It's dangerous buying things you don't understand. It's like going into a casino with a lot of money and playing a game you have no idea of the rules. There's a very good chance, if not 100% chance, you're going to go out of there losing your money, maybe losing all of it. So if I'm buying things I understand and that I can relate to. At least I understand how their business kind of works. I'm not going to get into businesses where I don't understand what's going on, but my friend told me to buy it, or it looks cool, or things like that. So that's how I tend to push people to make their own choices, but buy things that they can relate to, going forward. I had a friend of mine, he's in the market. He was like, I'm walking around my development and all I see are these Chewy boxes outside for their pets. He's like, I'm going to buy some. And he did, and he's doing really well with it. And to be honest with you, it wasn't a company I really was familiar with. But that's how people should look at it. Things you see, things you're familiar with, those are the things I would think that I would want to buy if I was trying to get into it. And as far as should you, well, let's look at the alternatives. You could buy treasury bonds, which you're going to be making 80 bips or whatever the 10 years trading at now. It's not much. You can leave it in cash. You can invest it in stocks. You could buy commodities. You could buy gold. And the millennials, and then you go buy Bitcoin. But again, unless you're going to sit there, if all these people, tell me how Bitcoin works. Tell me how the Bitcoin exchanges work. Tell me how the infrastructure is. Do you know what drives price? Do you know what makes it go up or down? If you don't, then you shouldn't be owning it. But what to buy? I don't think you should limit yourself to. I wouldn't limit myself to any one area. Now, if you're younger, you're more apt to take risk. So I would take more risk, and as that curve elongates, you should be diminishing risk.
And that's a really good point. I love your point about Chewy. I actually used Chewy personally. As soon as I discovered it, I pretty much stopped going to the pet store.
Right.
I love Chewy too. I did the same thing with Zoom Video. We're a full disclosure, we are using Zoom Video for this webinar here. I noticed it was being used all over the place. It's got a really great conversion on it, so I got some of that as well. We use it here at work now. With obviously with the coronavirus, I'm hearing that schools and all other types of places are using Zoom as well. So I really follow the trade what you can feel and what you can actually see and understand. That has
I think it's important.
really well.
I think it's important for young people because it'll keep them interested. It's relevant. And even for older people, I mean, you shouldn't be investing in things you don't know. But that's always something I've tried to follow. And as far as Zoom, yeah, I mean, I bought some Zoom, I think at 112 the other day, like last week, just not a lot, just because everybody was talking about it. Everybody was using it. The schools are using it. My daughter's universities and law school are using it. So I'm like, it's relevant right now. This is going to continue for a while. I'll dip my foot in. I didn't take a large position. I didn't dive in. I dip my toe in and I'll see what happens, just to kind of get a feel. I'll study it more. I'll learn more about it. But, it's very relevant right now.
Really important things there. So I got a couple of questions here that I want to run through here real quick.
Sure.
First one here is Craig, you had posted about physical gold purchases. I actually saw this post too, asked you about this a few days ago. How does one go about buying physical gold without getting ripped off? This is actually a great question because I don't even know the answer to this myself.
So here's the thing. If you go, you see the television commercials, from the mints or whatever, and they're like, buy gold. The problem with that is, and I've never done it through those kind of services, is the surcharges that they're charging you over the spot price is insane. Yeah, it almost feels usury. So you need it almost. Now, it depends what you're buying it for. If you're buying it for like an asset that you're like in your investment portfolio, you need to make up, 15% just to break even because of the surcharges you're buying. Now, if you're just buying it, as I do, for a store of value as a hedge and just to kind of hold, and you don't really care, the day-to-day fluctuations or if it's moving, then that's another thing. So there are some places that are obviously closed right now, because I just called my guy in New York City, that are more of a wholesaler, and they just really want to make money on the spread. It's almost like the NASDAQ used to be before Bernie went away. You buy 3/8, you're going to sell at a quarter, and I'm going to make that spread. So there are wholesalers in New York, in 46, 47th Street, that you can buy gold and you'll pay $10, $15 a piece for a 1 ounce piece, maybe $20 over spot, which, is not terrible, based on the price of gold now, it's, not high at all, 2%, maybe 1.5%. And you can find them, and they're more of traders. They're not looking to gouge you on the sale. They're going to buy it, whatever the spot price comes in. And you're going to buy it and you're going to pay $20, $25 over the spot. So those are the ways I do it. I go into the city once a month, and buy a couple pieces. So,
and obviously you trust the person that you buy it from. You have a relationship with them. I'm sure that goes into it.
Yes. You don't want to get conned, but these are people that have been in business, family owned, for I think 70 years, the person I use. And the thing is, there's times where I'll bring my gold that I bought back to them and they'll just give me the money for it. So, it's a give and take. When gold hit 1900, now it's been a few years, I sold some to raise cash to put into other assets. So, you don't want to get rooked, but there's definitely places to acquire it at less than, the huge surcharges that they can charge you.
All right. And then, so another question we have here, we're going to switch from gold to options. So Nathan is actually asking, do you follow options flow? You had answered earlier, you do kind of a little bit, but then he goes on to say, sometimes you show a post buying 1 call or 5 calls or 30 calls. Is there a method behind this on how you choose your position size? And then I would also add, because this is a question that I had earlier, how do you also choose the strike? So how do you choose the size and then the strike once you've located an asset that you actually want to purchase?
Okay, so and they work interchangeably, so that's a great question. So how I decide the strike and the month, how I do it is, first question, is there an event that I'm trying to capture or exclude from my purchase based on the month? So am I trying to capture an earnings call? Do I know the company's coming out with a new product? Is there some kind of shareholder activity that might be taking place that I'm trying to capture with that or stay away from? So like, I think April options expire April 17th this year. So if there was an event, April 14th, then I'm going to buy the weekly April 8th if I'm trying to avoid that, because I don't want to get mixed up with that. And there's a good chance that the price will come down, the volatility will come down because it doesn't capture that event. And so that's how I determine the month. Now, if I'm not sure about anything that's going on, I push it way out. Like yesterday, I bought win calls that expire in January because I really don't know what's going to happen in the next month. But I do think by the end of the year, things will be up and running. And I think a lot of good things are going to be happening to Macau. There is a caveat, which we'll discuss later. So that's how I determine the month. What am I trying to capture, if anything? What am I trying to exclude? The price is, what price do I think this stock can get to with half the amount of time remaining till expiration? So let's use Apple, for instance, since it's a very widely traded name, everybody's familiar. It's around $250 a share. Let's just say, for argument's sake,
Exactly,
yeah, $250 and change. So let's say, just for argument's sake, I want to capture the Junes. For some reason, there's an event, maybe a new product launch, whatever, in June, and I think the stock can be 300 by then, just round numbers. So I would pick the strike that gets there halfway with half the amount of time length. So what do we got? It's March, June, it's 3 months. So 45 days in, I think this stock can get to 275. That's how I choose to strike. So I would buy the 275 calls, or thereof. So I choose the month based on, activity or events, and I choose the price based on what's the price it can get halfway there with get to that price with half the time remaining.
All right.
Till expiration.
All right. Awesome. Now,
and then the amount. So the amount is, I'll basically decide what kind of car I want to put into capital at risk. I want to put into the trade. And then whatever the price of those options are, that's how many I buy. So if I'm going to buy $1,000 worth and the options are $1, then you buy, 10. If you want to buy, if I'm going to expand that and the options are $2, then I buy 5. So it's based, I develop how much I want to put into it, and then that kind of based on what strike and month I buy is how many I purchase.
All right, and we got a great follow-up on that from Justin, who's saying, what about premiums being inflated at this time? So when do you consider implied volatility? Do you consider the actual premium cost in any regard more than just the complete nominal value of the trade? How does that factor into your calculus?
It factors in. I mean, it has to. So how it factors in for me, in the short term, and I'm talking the immediate short term, it factors in a lot less, because you are going to get outsized moves. You are going to get extrapolated, 2-3 sigma moves in these stocks. So you can afford to pay the implied volatility on a very short-term basis, because you are going to have theta burn, but it's not going to be as much as you think, giving the volatility. You know, they're not going to be as much theta burn knowing that a stock can move 10, 15, 20% in a day. It's just, you know, you're not going to have it. I mean, you know, there was, you know, you could look at the prices. So on a very short-term basis, it comes into play, but not as much. Longer term, it comes into play a lot. Now, it's kind of, so, you know, because at some point you think you're going to get back to a normal level of trading, and these implied volatilities are going to come in a lot. So that kind of goes against what I did when I just bought the win in January's. But I think that's going to have outside moves for an elongated period of time. I think a lot of these other stocks are going to have, the moves are going to be, you know, Intel's not moving 10, 15% all the time. A lot of these companies' moves are going to be very finite as we go through. But I think 2 weeks, I think applied volatility is going to be okay for me to take on the risk of that. Longer than that, I'm not sure. You really have to consider that, because as the ranges get smaller, the VIX comes in, the implied volatility is going to drop, the theta is going to rise, and it's a double whammy. So then you're going to almost need, you know, 3 times moves just to break even. So it does come into play a lot. It's a great question.
All right, awesome, and that's a great answer too. So I hope that answered your question. If you have any follow-ups, go ahead and get at me. Got another question here that is kind of related. You kind of touched on it earlier. I just wanted to circle back and answer it officially here. Do you average up or down on your trades as a rule? And then also, do you ever make exceptions?
There's always exceptions. Always. There are. I mean, anybody who says this is my hard rule, I never break it, then you're not in markets, because rules are broken, because your rules have all been broken the last 3 weeks. So I do not add positions that are going higher. That's just me. It's contrary to what people tell you. I only add to positions that I'm losing in, that are going down, and I try to rack and stack, whether it's with options. If it's stock, I'll add and lower my cost basis as it's going down, because it goes back to my first point. Before I do any additions, I ask if my thesis has changed. Why did I invest in this company, and have the fundamentals changed? If my answer is I invested because of reason X, A, B, and C, and my reasons have not changed, then I'm going to add to the losing position, because I believe that it's being mispriced. I don't add to positions that I buy that are going higher, because I'm just not comfortable with it. It's just not something I'm comfortable with. And sometimes it's bad, because I'll leg into a position. If I buy a third of position and it goes 10% higher, I'm not buying more there. I probably should have bought more, but now I'm just going to have a third of position, which is going to be higher. So I'm not comfortable buying stocks as they run, for the same reason I'm not comfortable buying stocks on big gap ups. My forte and where I've done best is when things gap down, when things come lower, and my belief in the story hasn't changed. That's where my best performances come. So that's what I do. But okay, I know it's against the grain. Most people tell you never add to a losing position, and I can't argue with them, because it might, you know, it's losing for a reason.
So you actually bring up a really great point, because that's one of my rules. And 2 things there. One of my rules is don't add to a losing position, because it's not really worked out well for me in the past. But just like you said, all rules have been broken. And I can't tell you how many times I've broken that rule, sometimes for the better and sometimes for the worse. So I'm really glad that you touched on that. I've done that myself. For me, it doesn't really work, but I guess if you have conviction, that's a completely different thing. So you had mentioned averaging down when the thesis doesn't change, or when the fundamentals don't change. We have another question here that's saying, do you still believe in go-go, and have you averaged down lately?
Oh God, we could have a whole hour on this company, as my friend Carter Monsbach would say. We've had many. We discuss this stock probably daily. So
would love to be a fly on the wall for those combos.
Oh no, it's a tirade, bad word laced conversations where we both hang up the phone depressed. It's terrible.
That's why I want to be there.
But so go. Okay, so I got into it because I like the premise of what they were doing. You know, Wi-Fi in the skies sounds really good, and it sounds like something everybody would want going forward, especially in this information age. So I bought into it, like I said, originally in the nines. You know, I added some down. I did average down. You know, when Oakley Thorne took over as CEO, I thought that would be a turning point. I was wrong. You know, when they started doing cost cuts, I thought that would be a turn. I was wrong. You know, they've been very poor at communicating with Wall Street about their story, about their plans. It's always we have things in the works. We have a lot of levers we can pull. And the sad part is that they have half their company is a thriving business. Their business aviation unit is fantastic. It's worth $1.5 billion. The street's basically pricing in commercial as like a huge negative number. Maybe even $1 billion now. I mean, I don't know what the market cap of GoGo is these days, but it's got to be about $200 million, right? Somewhere around there.
Let's see. Market cap for GoGo, 318 million.
All right. So if business aviation is worth $1.5 billion, they're pricing in commercial at over $1 billion of negativity. So, you know, they threw out some carrots that they'll get an investor to buy some into the company. That they might Delta free was a big thing. Then Delta came out and said it's a ways off. The technology isn't there, which was basically a jab at GoGo. And now you have the airlines in all sorts of trouble. Yeah. So I can't see Delta signing. You know, it was going to be a loss leader for Delta. They weren't going to make money on it right off the bat. I don't know if they're prepared to make that kind of investment now. And you know. The Bears have been right on this one. You know, as much as I believe that their product is the best in the business and their story is one that will come out the other side, and I think they'll be okay. The Bears have been right, and I've been wrong. I mean, you know, it's a painful. I try not to look. You have it right on my screen right now, and I'm trying not to look at that because it's a chart and it's not a pretty one, but. Yeah, if you go back to 9, you'll see where I bought in, and that's the Craig pain point. But yeah, I mean, this is one where I've just been wrong, and now it's a matter of, you know, and obviously now they're in an industry which has been decimated, the airline industry. So that isn't helping. You know, this quarter is probably going to be really poor. They just drew down on their credit line like $22 million. So we'll see. I mean, this is a ride out the storm. You know, there is very real risk of a going concern here. A couple wrong moves, this thing could go to 0, or it could, you know, shoot back higher, you know, 5, 6, 7. I don't know if we're going to see 9 in the next bit, but, you know, it's been a painful trade. I'm not adding anymore. I think you have to rush to get in here. I think this is going to be a longer-term story. If I didn't have a position, I probably would initiate one starting at this point, not a big one, you know, 15% of what I want my total investment to be, and see how it does. I think you're going to be range-bound here, 2 to 4 for a long time, and then we'll see if the CEO can figure out a way to make this work and get some of this debt off the books because it's heavily levered, over $1 billion in debt.
Yeah, so I was actually just going through the news feed here, checking out some of the Form 4s, some of the recent insider trading on this while you were explaining that. So
I mean, the beauty of GoGo is there hasn't been any insider sells. They've all been large acquisitions. Now, it's been basically by 2 people, Charles Townsend and the CEO, who bought most of the stock. So it's not like there's a mad rush from executives and insiders to buy. But the odd thing is there's been very little, if any, insider sell. So it's an odd company. It's you know, I think operationally, I think they're doing well. Communicatively, I think they're doing a horrendous job. I think their IR department is terrible. And I think that their lack of communication has hurt this company in the worst way.
All right, so let's shift gears away from something that's painful like that. Again, I apologize, but really appreciate the honest answer.
I'm gonna switch from order. I'm gonna switch to. I'm gonna switch mid-cast, I'm going to switch because I think I need it after that.
It's Friday. It's Friday. Let's do it. So we got another question here from Michael. He's asking, what are your thoughts on restaurants? You had mentioned, the reason I'm asking this is because you had mentioned that with the airlines being affected by what's going on right now, that obviously has a ripple effect that's affecting GoGo. How about restaurants? What do you think in terms of the actual stock? I know we kind of addressed how the landscape may change after the coronavirus passes, but what do you think in terms of like investment and stock for the restaurant area?
So first, it's not a area of huge expertise for me. I'm not intricately involved in the leisure dining or dining experience kind of stocks. I do own McDonald's as a staple. It's not something I track every day. I just own it. But if I wouldn't be rushing into the restaurants here. I mean, I think it's almost like rushing into the cruise lines. It's not my thing. I don't think they're going to be a huge V. I mean, some may. I mean, you're going to get some restaurants that snap right back, but I think there's certain industries, like, I don't think cruises, nobody's, I mean, there's cruise junkies, but the normal person isn't running out to book a cruise right now. You see the story that the virus lasted for 3 weeks on a boat. I mean, so there are industries I do like that I think are critical, that I think will have a nice bounce back. But the timing on those is, up in the air right now. But, that's why with options, it's dangerous, especially near-term options, because the bounce might not be right off the jump. It might be 3 months down the road, So, like people know I like American Airlines. I've been in it. I own it. I think the airlines most of the airlines are going to end up coming back nicely. They're going to get tons of free money from Uncle Sam. And I think that if we can get going by the summer travel months, and that's a big if, I don't know. It's up in the air right now. I think with the reduced price of fuel, because oil is getting crushed, I think the airline, that's been a real boon to the airlines, but they've just been destroyed anyway. I think airlines are critical. I think airlines will come back before restaurants. People are just going to want to get out of Dodge. Once they got the green light to travel, if they have the money, they're going to want to travel. So, and it could be a long ramp. It could be a slow arcing ramp. It might not be a sharp V. Obviously, casinos, I think more of so is just leisure activities and entertainment. I think Vegas will come back strong. I think some of the lodging stocks will come back strong because, like the Hiltons of the world, the Marriotts of the world. I think some retail will do better than others. Some tech will do better than others. And those are the areas I've kind of nipped at over the past 2 weeks. I've dipped my toes in. Those are my areas. Restaurants, gotcha. I'm not crazy about restaurants. It's never been an area now. I've never been an area I've been invested in a lot. So, but when I think about them, that doesn't excite me right here.
Yeah, no, I totally understand that, and I agree with you. I'm not in any hurry to buy restaurants either. Now, just to go back to one of the things that you were talking about in terms of picking a strike based on an event that you're trying to capture. When it comes for airlines, we had another question here. Should you be looking as far out as January? Where would you, if you were trying to capture that rebound, let's say that's what we think is going to happen. If you were trying to capture that, how far out would you actually be looking in terms of options in this regard?
That's a great question. So a lot of these things you have to kind of put together base case in your mind and then outliers. So, and there's a lot of questions right now. So for me, for an airline, it'd be like what I just said. Are we going to be up in time to get the summer travel season? Are people going to fly? Are we going to be cleared by then? Memorial Day weekend, are we going to be good as a country to be traveling to areas that might not be Miami, things that, beaches, Disney, is Disney going to be up and running in full force? Or are parents going to want to take their kids to Disney where kids are getting in and out of rides that are dirty and not sprayed down? So it's a really tough call here for airlines. So I'm going to play it two ways. I'm buying near-term options for bounces that could be elongated just because of news flow or oversold conditions, maybe 1 or 2 weeks out, so the IV doesn't kill me. And then longer term, I'm going to buy stock because I just don't know. When I say I just don't know, I buy stock because it's no timeline. You have a tendency to be able to ride out things longer. And there's just still a lot of unanswered questions. I do like airlines, so I will play it short term. I tried to play it short term probably about a month ago when I bought American at like 16. I got destroyed, went to 10. I did buy some when it got down to those levels. It rose back up a little. I think it's, I don't know, probably 14, 15. I sold some. I still hold stock. So, but I'll nibble. If it stays around these levels, I think the airlines, I'll nibble on Delta and American because I think Delta's the best run airline.
Yep, me too.
And I think international, at least to China, hopefully will start sooner than later.
Okay, so speaking of China, things that you're looking for in the hospitality business, let's dive into Wynn. I know that you covered it a little bit already. We got another question here from Zach. Hey, Craig, can you address the Wynn caveat that I tweeted to you about regarding social distancing in the casino?
Okay, I don't know if I saw it, but I understand it. So one of the big things I want to cover is, because I get into this with people on Twitter all the time, is dogma and your narrative your P&L doesn't care about that. You could think you're right and you get destroyed. No matter how right you think you are, the market doesn't care.
Right.
So I thought I was right on Wynn, when it was 100, then it dropped to 90, and I was right all the way down to 35, getting punched in the face every day. I did catch a nice wave up on the buy and the sell, but for the most part, this is one where, the narrative, my narrative hurt me. Now, there's a couple things. So when it comes to a stock like this, and I will get to the social distancing, when I said when you have to analyze whether the fundamentals change, whether you keep your investment, this is one where is a good example because the fundamentals did change on my thesis. They basically shut down the business. I mean, they closed all the casinos. So I would consider that the biggest fundamental change is you're not getting any revenue. So that being said, Craig, how are you an idiot and you still held this stock knowing you broke your own rule? Right, I did. I broke my own rule. The fundamental story changed. I still own the stock. And the only reason I didn't sell at the most critical moments is this. And this could be fabricated and it could be wrong, but it looks like the wave of corona is rolling east. Started in China, rolling east across Europe to America and so forth. China looks like it is recovering better. Macau, to me, handled this better than any other place. They had initially like 10 or 15 cases. They've had none in a long time. They basically shut down and isolated. People are starting to tweet from Macau. The business is getting back to normal. And Wynn generates most of its income from Macau. Okay, so that being said, that's why I held on, because I wanted to see a green shoot from Macau. I think that will be a very good thing. Number two, the social distancing. So yes, I think that's going to be an issue. I think that with all the other industries too, I don't think it's going to snap right back. But at this point, they have zero revenue. So if they can get, Macau GGR growth was like negative 90% in February. It's probably going to be the same, if not worse, in March. So number one, the year-over-year comparisons next year to this year are going to be humongous. Okay. And any growth that you start to see, I think is going to be rewarded because it takes going out of business off the table. I think that, Vegas, they just said they're going to open in 20 days. We'll see. I don't know. Yeah. I do think social distancing is going to be an issue, but like I said, any revenue is better than what they're getting, which is a big fat zero right now. And I think that's the lifeline. I think that Wynn did all the right things. And this is the other thing. I think because the names like Wynn and Las Vegas Sands cooperated with the government of Macau, they're going to get a lot of benefits from that. The licenses are coming up for renewal. I think they're going to get a break with that. I think the tax rates are going to be lower. I think they're going to get a break with that. I think the money transfers are going to be loosened up. And biggest of all, China hates Hong Kong now. And they're trying to make Macau the next financial capital. So I think that's going to play a very big role. The big caveat in all this and the big ointment, and I spoke to you about this before, and this is what would actually cause me to sell Wynn, is if I see another outbreak in China, a re-emergence, then it's game over. It's game over. It's game over. And then you have to just take your marbles and go home. And then I would sell my Wynn position and look to re-enter when and if that ever gets cleared up and save what I can.
So that's a great answer. I hope that answered your question. I believe that was Justin's question out there. I hope that answered it for you. I want to take a quick moment here to let you know that this webinar will absolutely be recorded. It will be available to view for free. Both Craig and I will share that link when it is available later this evening. If you have prior engagements and you need to get going, don't worry about it. We will have this available for you to watch later on. Craig, if it's okay with you, I'd like to continue. We got a whole bunch of questions here. Do you have the time for it?
Yeah, let's go.
All right, let's roll through a couple of these here. So first one here is great advice on charts. Please elaborate on your take on close date funds versus regular mutual funds for retirement.
So I own mutual funds. I'm not a big fan of them, but they are boring and they're okay. Closed-end funds, listen, if you and this is good. We should get into this. So we're talking IRA, 401, retirement money. I think anything that you invest in that you keep in your own mind has the time horizon for retirement. People are blowing up my phone. My 401k, my IRA is like melting. I'm like, when are you retiring? 23 years. Okay, you're going to be okay. Should I sell everything? Well, you're already down 30%. Do you really think that's the wise move? If you think we're going into a depression, and you think that we're going to be in dire straits for a long time, then yes. But you have 23 years to retire. Now, that story, I'm in my 401k, I've been adding. I just increased my contributions because this, I think 10 years from now, this is, in my life, there's been 2 or 3 golden opportunities to buy. 2001, the tech meltdown. 2008-9, the financial crisis, and this. And if you've bought at every one, you've done well for yourself. So now, as you get older and that scale goes higher, you need to be exposing yourself to less risk. And the people I feel terrible for are the people in like the 60s who are looking to retire very soon, who now just took a beating and now have to decide, can I retire? Now if the market's a V recovery, okay, you'll be okay. But if it's not, what does that mean for you? It means that, sadly, you probably were riding the wave of markets going up every year for a decade and got a little ahead of yourself, got a little bit over your skis with aggressiveness. And now things have repriced. And now what do? Do you go to cash down 30% when that's your retirement in 3 years? Do you buy treasuries that yield you absolutely nothing now? Do you keep it in stocks? Those are the people I feel really bad for because they have some tough decisions to make. If that's their whole nest egg, do you sell it out and just keep the cash you have? And it's a really tough decision for those people. For anybody 50 and under, I think you're going to be fine.
Well, really good piece of advice. Great answer on that. Let's get to something a little bit more quote unquote exciting. We'll call this a rapid fire. I got 3 things here. What's your position on cannabis stocks? Reason behind your Twitter long, and what do you think about the banking stocks? So Twitter, cannabis, banking.
All right, cannabis. The only stock I own is cannabis related names is GW Pharmaceuticals, GWPH, because it's got medicinal uses. It has some legitimacy to it. Now listen, all the cannabis stocks have gotten throttled. I mean, Tilray. I mean, what was that? Remember when that was like, what was it, 300? It was going up 100 a day, down 100 a day.
So real quick, Craig, on Tilray, I remember one day it was near 300. I mean, it was in the 200 handle somewhere, and you're talking about buying puts, and I looked at them, and the price was so outrageous.
Right, and I made money on those.
And you just had one simple response. Guy shrugging. I look over the next day, the thing's from the 200 handle down all the way to like 170 or something like that, and I'm like, oh, you did it again.
I mean, they've gotten destroyed. I still think this industry has a lot of regulation and shakeout to happen. Now, my buddy, Retro Wall Street on Twitter, he is the, connoisseur on that stuff. So if anybody has any questions on the cannabis stocks, hit up Retro Wall Street. He's a great guy, fellow Steeler fan, and he has a lot more insight. I've stayed away from them just because when new industries come, there's a lot of shakeout. I think it's still happening. Like I said, I own GW because it's more commercial and medicinal. I do think there's going to be winners and losers. I just have no idea which ones. Tim could probably give you a much better analysis than I could.
I posted Tim's Twitter handle in the chat for anyone interested in following Tim. So excellent. That takes care of cannabis. What about Twitter?
Twitter. Oh, another one that Carter and I discussed all the time, way back, and we still do. So, Twitter. Now, it's been run like Jack Dorsey's personal greenhouse earth conservation site, without regard for shareholder, revenue, monetization, anything. So, why are you in it? Well, plain and simple, I think it's the best platform. And I think it's the best news service, which is kind of odd to say, but I think you get more instantaneous breaking news from Twitter than anywhere else. At least I do. Sure. Now, they just reined in their projections. They're carving out. They took down their numbers for the quarter, which is good. That's when I like to step in. And they're having a big shareholder update, I think April 30th. And I think at that point, they're going to announce that their DAUs are significantly higher. People have come to Twitter during this being, quarantined. I think Twitter's done very well for itself. I still don't think they get it. I mean, there's so much they could be doing with this platform, from live betting in sports to even FinTwit to like stocks and stuff. There's just this. I ultimately think somebody smarter than them buys them and does well by them, whether it's Google or I think smarter people are going to buy them. Ultimately, and I think Twitter's a great platform. I just think the management team is questionable. So that's a long-term hold. It's not something I'm really going to trade around. I'll just buy it and stick it away. I mean, it's under its IPO price. I think it was 26. So, I mean, look at where it's gone since it's IPO, and look at where the other stocks have gone. So, and what was the last one, Ryan?
The banking sector, or banking stocks more specifically.
I've always loved the banks. I've always been in Goldman and JP Morgan. This is probably the first time in 5 years I don't own a single financial institution. And the reason for that is this isn't a banking crisis. This is an economic crisis. So unlike 2008, 2009, where you knew the banks were getting a bunch of liquidity and they were going to be saved and these prices were way, way too low. I think when things start coming back, I mean, you're going to have ZIRP forever. You have, you're going to have loan defaults, although I think they're going to try to curtail them. I mean, lending, I know they're going to try to lend, but, who's going to be in a position of, I mean, there's always people in a position of borrow. I'm just talking overall as in America.
Yeah.
I'm sure their prop trading desks, which have been greatly reduced, are doing great. So I'm not in a bank right now. I'm looking at Goldman Sachs. At some point, I will get into Goldman Sachs. I'm not in it yet. I've loved JP Morgan for a long time, but I mean, it's just the carnage. I mean, it was 130 and now it's 80. I mean, think of the moves in some of these financial stocks. I mean, I think Goldman Sachs was 250 at one point. So I'm not in any financials right now. I'm sniffing around Goldman Sachs. At some point, I will. I mean, look, it was what, 250?
275 on the high.
Yeah. So, and now it's what? 160.
160.
So I mean, yeah, I mean, I'll put in some bids under where it is now, and if we get another flush, I'll probably get filled. Somewhere around the mid 140s, maybe somewhere around there, and we'll take it from there. But I'm not in a rush to buy banks right here. That's not going to give me the biggest bang for my buck. As an investment, okay, but as a trade, I'm not touching it.
Gotcha. Great answer. Another question here. There are 3 questions that are actually kind of related, so I'm going to lump them together in the interest of time. The first question was, what is some advice you'd give your younger self about trading? And then a related question to that is, what is the best way to grow a smaller account?
Okay. The best advice I could give myself, a younger me, is to, and I'll say this, the number one killer, I'll number the killers 1 through 10 in the markets, and they're all arrogance, all hubris. Arrogance will kill you here, kill you. The market will give you humility. So if I could teach my younger self, it would be to learn that sooner. When you're wrong, cut and run. You don't, pounding your chest that you're right, meanwhile your P&L is drowning, gets you nowhere. It gets you nowhere. So learn to take your lumps and let them teach you that you are fallible. When you're young, you don't think you are, but I wish I could teach myself that. I've made so many mistakes that I wish I could change.
I'm really glad that you said that, because that's actually one of the lessons that I lived by as well. When I first got into this, one of my friends had been trading for a long time, older than me, and he said, Ryan, before you get successful at this, you're going to have to learn how to lose money before you learn how to make money. And I didn't
100%.
really understood with that. I didn't really understand what that meant at the time. But man, if I could go back in time now, I would absolutely learn the same lesson. I'm so glad that you mentioned that as a piece of advice. And then just to reiterate, what's the best way to grow a smaller account?
So it depends. If I had a smaller account, it depends what you're trading. Are you trading stocks? Are you trading options? If it's a smaller account, you're probably not trading options, and I wouldn't recommend it. Options are one of the most riskiest, other than futures and commodities, probably one of the most troublesome tools you can get yourself into as far as blowing up accounts. But if you're trading stocks, I would. Now they're referring to trading, right? Not investing.
Yeah, it wasn't specific, but I would say probably both. If you were starting,
so if you're investing,
to grow an account, so let's assume trading first.
So if you're trading, you take your small gains and you wait for better opportunities. You don't force it. If you have a nice little gain in something and you see an opportunity somewhere else, you take it, and then you wait and you do some analysis, and then you take small opportunities. Small gains add up. You don't need to hit home runs. Take your singles, take your doubles. They'll all add up. You still have 13 on the scoreboard by the end of the game.
Right.
Now, as far as investing, that's just a matter of buying things that you understand and letting it grow. You don't trade out that. That's the only way you're going to grow in investing, is to just buy things that you can understand and let it take its course.
All right, and then another one here real quick. Do you have any good book recommendations for learning the basics of options, i.e. beta, gamma, delta, so the Greeks?
Yes, I actually do. I don't know if they're in the office, but if they're not, I will get them to you, and you could post it, or we can post them. I thought I had a bunch in here, but I do not. So
okay, that's okay. I actually have one here that I would recommend. You tell me if you've heard or seen this one.
I think I posted one. Yes, actually, that's not that. I have that book. That's not a bad book.
Yeah, so I actually call this my options Bible.
That is a good book.
As you can see, I purchased this on October 5th of 2015.
Yes, that is actually a really good book. Mine's marked up with highlighters and
Post-it notes sticking out the top.
Yeah, all over. Oh, absolutely. Absolutely.
So Gianni, we'll get you a more extensive list in the future when Craig puts it together. This one, we both agree on. This has been really great for me. So I hope that answers your question. Let me go ahead and take a couple more here before we turn it over to some fun stuff. Let's see here. I see you also have a separate hedge account. What are some typical assets and instruments that you would have in there, and how often do you turn over that side of the book?
So that's my pillow at night. That's always cool and comforting. Okay. That's when the apocalypse is happening and I'm getting I'm getting smashed in my face in the equity markets, and I don't even want to look. I go there and I sleep better at night. And what's in there is, it's probably about 54% fixed income. And that consists of some, anything from treasuries to preferred stock to corporate bonds to munis. It's just things that I know will be there tomorrow. I'm only buying high grade corporates. I'm not buying anything junk, BBB better. I'm not buying any crap. I do have like 8 or 9% stocks in there. It's very small. I have some UITs and I have mutual funds. So yeah, the mutual funds, but those mutual funds, I've had them for a long, long time. So that account is mostly fixed income to keep me warm at night when things are freezing.
I actually really like that. I may steal that from you and use that in the future. I like that analogy a lot. We had another question here that said, you mentioned in the past you look at volume. Do you look at overall volume heavier than normal, or do you just look up the volume? And if so, what tool do you use to look up the volume?
We talking option volume?
It wasn't specific, but let's start with stock volume and then go over to option
I don't
volume.
really look at stock volume. I mean, it's not really it's not any kind of an indicator for me.
Okay.
I mean, with smaller stocks, yes, like GoGo, which usually trades like $1 million, $1.5 million, $2 million a day. It trades 10 million. You're like, whoa,
gotcha.
Something happened. Somebody got in, somebody got out, some event happened. But like Apple, I don't know, if it trades an extra 10, 20, 30 million, I don't care. Option volume matters sometimes to me, and I use Power E-Trade for me is where I find my where I do a lot of my options deals.
I actually use my broker too to monitor option volume. I use Thinkorswim from TD Ameritrade. So pretty much any broker that you have that's going to allow you to trade options is going to have the volume information on those options.
And I like Power E-Trade because it has, all the Greeks listed side by side, so you can kind of see how everything's flowing. And then you flip it, you hit a switch, and then it lists the volume, the open interest, the trades, how many traded today, the bid, the ask. So for me, it's a very useful tool.
Okay, and then one more quick one here before we turn it over to some quick fun stuff. I have a habit of selling too soon. How do you stay in winners as long as possible? So the term that I've heard you use in the past is let your winners run. How do you do that?
Right. So as I said, I don't add to winning positions. So knowing that, I have the ability to let them run a little, I give them a little bit of a longer leash, because typically, for me, it's not a full position. Because I didn't go in with a full position and it started running, I can afford to let the leash out a little bit because I know what my risk is. Now, there's a couple things I want to say. Some people use running stops, which is not a terrible strategy. But learning to let them run is something you're going to have to learn its feel. You just kind of know when something's running. Like Win last week, you saw the momentum bounce, and then it just kept riding, and then last week the momentum stopped. So I sold. So you kind of, it's a feel for where the market might be taking it. It is hard. It's hard to let your runners. I mean, typically, here's what I do. If an option is up 100%, I take at least 50% off. Because think about it. If somebody said, here's 1,000, and then the next day they give you 2,000, you're gonna be like, okay, I'm good. You wouldn't be like, all right, I'm gonna see if I can. You'd be like, I'm good. So don't get greedy. And I want to say a couple things. A couple really important things that a lot of new people ask me. So don't change your price target because of performance. I think that's very, very important. Okay, go into the trade knowing your price points. If something is 1 and you say if it hits 2.5, I'm going to sell, then sell.
Right.
Maintain the discipline. Now, there are exceptions, yes, but don't let price change your strategy or your tactics. That's how you become successful, and that's how you take smaller accounts and turning them into bigger accounts, is following your plan. So, if you said I'm buying Win at 40 and I'm going to sell it if it hits 50. Well, that's good. It hit 50. It went way past it, but you made 10 points. You made 25%. So that's was your plan. You execute it and you get out. I never look back on trades that I could have made more on. I don't. It's not not good for you mentally. And there's always another good trade out there. No matter what you did and sold, there's always another opportunity that will come. So, I just wanted to get that out, that stick to your plan, set your goals. And here's the other thing that somebody asked me before about hard stops. I don't believe in hard stops, putting them into the – now, this is if you're a trader, not an investor. I don't believe in hard stops. I think the flash crash taught us something all about that. You could have gotten filled, and then it went back to the price you would have had, and you are now out of the position, and you got crushed. If you're trading and you can't watch your trades, then you shouldn't be trading. Gotcha. Especially with options. Options you really don't put in stop. I mean, you can, but with stock, if you're trading stock and you can't watch day to day, minute to minute, tick to tick, it's not a part-time gig. You shouldn't be in it. Because putting hard stops in, I found, has caused more heartache for people than it's helped.
Yeah, it has helped me on occasion, but there have been plenty of times where I've just been, absolutely flushed out of my position. It goes down to my stop. I get kicked out, and then it goes right back up. And it's like, if I just hadn't have done that, I would have been okay. But emotions were ruling the day at that time. So
no, and emotions take over. But yeah. I mean, if you watch it, you can scale out too. You don't have to sell all when it hits your price point. If you're not comfortable with selling, if you think the selling is irrational. I mean, it all goes back to your plan when you went in. And I think that's the most important thing. Have a plan.
All right. So that's great. Craig, I thank you a lot for going into all this. Hopefully we can have you back. I did want to touch on a couple more things here. I know that you have an immensely talented daughter who takes after you in terms of the music. So I wanted to give you an opportunity to go ahead and talk about that real quick.
Oh, my daughter is a senior. My youngest is graduating from USC. Well, she's still graduating, even though they postponed it. She's a music major. She has some songs out on iTunes. Her Twitter handle is Alexa Marissa. So follow her. She's great. She's putting up some great TikToks that I just find hilarious. I'm not good. I'm an old man, but she is fabulous. And she's doing some great things. So definitely give her a follow, and that would be great.
So that's Alexa Marissa with 2 S's and 13 at the end, right?
Yes.
All right. So I'm putting that
Alexa
in the
Marissa
chat.
13.
There you go. And then I also noticed that you've got a Steelers shirt on. So I know you're a huge football fan. So
yes.
So talk about that real quick. And then I have an idea that I want to run by you here.
So yeah, I mean, I've been a Steeler fan most of my life. I wanted to be the kid in the Mean Joe Green commercial. My mother found a old Mean Joe Green jersey and used to she used to allow me to pretend I was the kid in the commercial. I must have made her throw me that jersey 100 million times. And follow my friend Mark, SC Blitz, great blog. They got some great content. They do good stuff there. And they're not all about how Mike Tomlin is a god. So that makes me a very happy man.
Real quick, in 20 seconds or less, give me your synopsis on Tomlin. I gotta have it.
My synopsis on Tomlin?
So he's not a Hall of Fame coach, you don't think?
Well, if Cowher gets in, he's got to get in. I mean, they basically are the same. So I don't think Cowher's a Hall of Fame coach. So you're asking the wrong person. I think Hall of Fame is for the elite, but we've kind of widen the spectrum of who's a Hall of Famer now. So, yes, Mike Tomlin is probably going to get into the Hall of Fame because Bill Cowher did. I think Mike Tomlin has been a colossal disappointment. I think he's underachieved more than any other team in the last decade. I think with the talent he had to not even be in the multiple AFC championship games all the time. He lost to Tim Tebow. I mean, come on. He lost to Blake Bortles. Embarrassment. I mean, and we get to look forward to what will be a disappointing season for the Pittsburgh Steelers under Mike Tomlin's tutelage. It'll be great. Can't wait.
Hopefully we have a season. Hopefully all of this.
Yeah, that's another thing. Let's hope we have a season at least, because
And,
I got to
and
take my friend.
if we do, what do you think about maybe like a markets and football discussion on a weekly basis? Would you be into that?
Yeah, we could do we could actually do something like that. Would be good. Like a football and come up with you're good with that stuff. You're the marketing guy.
I'll
You
come up with something like that.
An acronym or a title. Oh, yeah, we could do a Sunday night, football and futures.
Yep, football and futures. See, you got a marketing guy in you too, Craig. Come on,
Football and
football and
futures.
futures. That's perfect.
I can discuss how the Steelers blew that game because Mike Tomlin blew another challenge and didn't manage the last 2 minutes right. And then we could talk about how, the markets are falling apart. It'll be great.
And I'll throw in some quips about how disappointed I am in the Bears as an organization because, man, I bleed Chicago
Well,
blue.
You now have Nick Foles.
Yep. So we'll see how it goes. That's a great idea.
Good luck with that.
No one else is doing that. I know a lot of the Benzinga Pro chat community likes to discuss things around that time anyway. So having a nice little show that ties in some football to it, that sounds awesome. Craig, I really appreciate your time today. Thank you so much.
Absolutely.
Your wisdom is invaluable. Hopefully I can have you back pretty soon.
Sure.
We had a whole bunch.
Hopefully the markets turn around a little bit. We could be a little more positive.
All right. Sounds good to me. So thank you very much for joining us. Thank you, audience, for joining us. Reminder,
Thanks,
I will have a link to the webinar available later today. So just remember, Zingers, until next time, happy trading.
Thanks.